All right, everybody. Today's guest is Gareth Soloway from In the Money Stocks. Glad to have Gareth on to talk about the markets, get his take, and help us out here, kind of navigate these wild, turbulent times. Before we hop into it, Gareth, you want to let us know if for the people that might not know who you are, your background.
Sure. And thanks so much for having me. It's always great to have a chat on the markets, especially in these turbulent times. And for those of you that don't know me, my name is Gareth Soloway. I've been trading the markets for about 20 years at this point. I started in the late 90s with the dot-com bubble and kind of witnessed that collapse. And then, here we are 20 plus years later with cryptocurrency and everything. We'll talk about that, what's going on there. But basically, there's nothing special about me. I want to be that to say that and make that clear. I started in a lower income family. Both my parents were teachers. And, I was never exposed to investing until high school when I joined the investment club. And it just so happened to be in those late 90s periods where my fake account of $100,000, I was able to make into 300,000 in a matter of a month. And it was so addicting, when you don't have that type of money and to be, even though it was fake, to have that the ability or think that you can actually do that in real life. It's very addicting, as many people find out in the cryptocurrency space these days. So bottom line is I went on my merry way and I was dedicated to learning how to trade, to read the charts. Initially, when I started, I had no clue. I had $10,000 to my name. I got leverage 5-to-1, so 50,000 to trade from a firm. And I lost lots of money. My 10,000 went to 7, to 6, to 5. I worked 3 side jobs to replenish it many times over the course of my beginning years. And then finally, I got the hang of it. And I finally turned that corner, learning how to read charts better and better, learning what probabilities were, learning how to kind of control your emotion and become more disciplined. And in 2007, I started inthemoneystocks.com. It's been 15 years now of teaching and helping people learn how to trade and make money in the markets. And then recently I launched verifiedinvestingcrypto.com, which is just for cryptocurrencies.
Wow, amazing. Let's hop right now into kind of the markets. We'll talk about what you're seeing right now. Then we'll get into maybe some of your processes that can help out individual retail traders. And then we can hop into some of the questions that the community has asked. So let's maybe start with the, I guess, S&P 500. Have we reached a bottom, or is this just a dead cat bounce taking place right now?
So the big question is, right, when we talk about bottoms in the market, unfortunately, we're in a period of time where the Federal Reserve is in total control of that. And what I mean by that is that as long as they were printing the massive amounts of money that they were, the markets just went up and up and up. And yeah, you had the COVID collapse on panic right here and everything. But if you go back to 2009, we were kind of stuck in this sideways upward sloping channel as quantitative easing was going on. And remember, quantitative easing started in 2009 with the Great Recession end, and it basically continued all the way through. And then right here, so this was a taper tantrum right here on the chart. So this is where the Fed threatened to raise rates. The market dropped 20%, and then they backed off and they went back to printing money. And then here was where COVID, it made it seem like the world was going to end. I mean, we didn't know what was going to happen, and you had this major decline. From that major decline, they printed more money than they ever have before. In addition, the US government was printing and sending checks out to Americans. Well, what happened? The market became a market on steroids. It went insanely high. You can see how quickly it went above this range. And then what you can see here is fascinating. We've actually come back to that upper range, and notice how the market is bouncing right there. Mm-hmm. Now, unfortunately, I think this is just a bounce, meaning that maybe we go up another 100 points on the S&P, maybe a little bit more. But if the Fed is truly pulling all the stimulus away and sucking money out of the system by raising rates, it makes a lot of sense that we should start going back into this longer term trend at the very least. So of course, you're going to have support at the high end, but after that bounce, you probably trade back inside that range. And then at that point, we'll have to see where the markets bottom out. Again, a lot will have to do with where, do we see a recession? Then the markets probably go even lower. But if there's no recession, my target on the S&P, or this is the Spiders, which is an ETF that tracks the S&P, would be this former COVID high pivot, right? So this is just before the COVID panic. And then look at how the markets just seem like they want to go back to that level. It's also in the midpoint of this longer term channel. So just some cool ideas and some cool charting for you guys to kind of check out. I love kind of showing people this because a lot of people think technicals are just a bunch of nonsense. And then you look at the charts and you're like, wow, that really did bounce right at that level. And it's just very cool stuff.
Yeah, absolutely. I get that comment quite often about it's astrology or whatever they say.
Yeah.
I'm like, okay, well,
What
it
I
is
like to
what it
say
is,
is
right?
like, if it's astrology and I'm making money off of it, that's all fine and dandy.
Bingo. Okay, so I like those levels. Do you think that the Fed is going to capitulate at some point? And if so, are we done with the V bottoms, or is it going to be more of a process to maybe form these bottoms, or will they capitulate? Do you think?
Yeah, so I think that the Fed is now has an issue, right?
Yeah.
In the last 20 years, there was basically no inflation, maybe 2%, 1%. I mean, that's what they were reporting anyways. So they didn't care about printing money anytime the market needed or the economy needed it. The problem is now you have 8.5% inflation, and that is very, very high. So they can't go right back to printing. What I do think will happen, though, is that they're going to continue to raise rates and be aggressive and try to bring inflation down. Later in 2022, early 2023, the likely scenario is the economy is going to start to sputter. It's going to go into recession. And at that point, you're going to see unemployment start to rally. Inflation has probably come down at that point to like 5%. But once you have unemployment that goes to like 6, 7, 8%, and you have that lower read on inflation, the Fed is going to say, okay, well, which one is the worst issue here? Well, 5%, it's not good. But when you have 10% unemployment, we got to attack unemployment. And I think they're going to then capitulate in that terms,
Okay.
and they'll start printing money again. So again, it makes me longer term very bullish on gold, eventually crypto when it bottoms out, these alternatives to the dollar kind of thing.
Right. So let's actually take that into gold. You've made some bold calls on gold, saying that is going to be one of the top performing assets in 2022, if I'm correct. Gold's been taking a little bit of a back seat here, but really, I mean, for technical traders, it's kind of just pulling back into a previous area of resistance, I guess.
Yeah, yeah. And the great thing about it is that gold's up a couple percentage points for the year. But I did make that call, you're right, in December. And right now I think Bitcoin's down whatever 30% or 20% from the start of the year. And then you have the stock market, the Nasdaq's down, from the 52-week highs that were just in late 2021, like 25%. So again, sometimes it's a weird thing, but sometimes an asset that just kind of holds steady or goes up a little bit is actually can be the best performer and the safest place to be. It's not really the sexiest, right? But at the same time, sometimes preservation of capital is really important. So on gold, you've absolutely seen a breakout, and gold is doing exactly what you would expect it to do. So there's something called a retrace after you break out, where something breaks out and then it has to come back to home base. So you can see right here, you had basically this longer term up move from 2018 to 2020. And then we basically had 2 years of just chop, right? But that's actually a bullish consolidation pattern. And then you can see if you connect this high with this high and this high, you broke out above that. Recently, we went up to what's called a perfect double top, which is the high pivot here. You can see it was right there as well. And then you're coming back to home base, which is what we call the scene of the crime. It's that same trend line. And I always like to use the analogy of, think of it like a kid, right? In the beginning, the child is at home, they're young, they're not going out, they're not doing anything. Then as they get older, they start to think about going to college. So they're kind of, they're saying, Mom and Dad, I want to get out of the house. Why do you make me stay? And why do I have a curfew? Kind of they hammer on it. Eventually they go off to college, they leave the nest. But you know what? That child eventually comes back for Christmas or Thanksgiving. So they come back to mom and dad's house right here before they go on their merry way up again. So I think that's what's going on with gold. I think that, again, if you're someone like me that believes that the Fed, yes, they're pulling back on stimulus now, but the first sign of major recession, they'll go back to printing money, which is what they know best. Then gold is a great place to be in these crazy times right now.
I would have to agree. Is there a key level that you're watching that if it were to break to the downside, you might have to negate the trade or kind of change the, I guess, thesis?
Yeah, I mean, at least in the short term. So one of the levels, this level here is a really big one. This one we just hit. I just added to my gold positions just last Friday as well. There's also this trend line which you can kind of take note of, which is right there as well. So if you connect these lows here, it gives you that same level. So this is a really 1800 is like a major important level. If that were to get broken, then you start trading down potentially into the high 1600s or the 1700s. But I'm in the camp that I personally don't think that 1800 will get broken. But again, always as a trader, and again, I've been a trader for a long time and made plenty of mistakes in my early years. all the time you have to look at both sides. You just can't be like, oh, this is going to be a great trade, I'm going to make millions of dollars. You have to say, well, what if it doesn't work out like I think? How do I react? What do I do? And that's a great point to talk about. Well, what if it doesn't work out? Where are your next levels?
Absolutely. Let's hop now into crypto, more specifically Bitcoin. Want to get your take there. You made a pretty bold call, I believe it was to 20,000, but now it's potentially even lower, correct?
Yeah. So back when it was, in October, November, I talked about how, everyone was so bullish on crypto and talking about how it was going to go to 100,000 by the end of November and then 250 by maybe December 31st. And I just didn't see the charts telling me that. The chart was a classic double top. It pierced the recent highs from April. In fact, let me bring that chart up now so we can kind of take a look at it. But that's very normal for double tops to do. And I want to be clear on this, is when you have this double top in March and April, and you got just briefly above it, the markets do that. If you look at double tops, they almost always breach on the second high. And what's going on there is the second high is where euphoria is even greater. So you have more small investors just rushing in. We know we saw that the futures, the futures on Bitcoin ETF launched right there too. So there was just so much hype. But ultimately, one of the keys to note is that you never really stayed above the level for a day or two. And it always came back in. And with all that hype amongst small investors, you have to say, well, why didn't it go higher? Well, the answer very simply was there was big money selling into it, right? So that's the only way they could force it down, is if big money was selling. So we did come back in. I made the call that it's going to go to 20,000. As of now, that's still in place. Although, like you said, there's likely a further downside target, which I can go over in a minute. But one of the things I want to show you guys is this is really cool stuff. It's called parallel channel trading. And what you can see here is that if you connect these lows here, so these recent lows before the breakdown, and connect these highs, you can see how these highs, pivot high, pivot high, pivot high, they all align. And then these lows align as well. And so that was creating what we know as a bear flag. And that told me that we're going to break lower, and we have done that. And what's just so cool here is, let me remove that, is if we do a new channel, and channels, again, this is something that gets a little bit more complex with education, but it's so worth it. Take a look at this new channel, which got me to actually go long Bitcoin just recently on this last dip. Take a look at this. Mm-hmm. So what I love showing people about this is, look at this new channel where you have a low here, you touched it right there, then you broke above it, then you touched it on the other side there, right there, and then look at what we just did. And the same thing up here. Look at this high, low, like right there, and then back here. So channel trading, you'll find that markets, for some weird reason, they move in these kind of channels where support and resistance, and it might be downsloping or upsloping, like I just showed in the two examples, but it's very cool. So I did end up short-term. This is just a short-term trade, but I did end up going long Bitcoin here for a move back to 33, 35,000 just as a trade, before I do think it goes lower. And I know I don't want to keep it too long-winded here, but just to think through the target that I have on Bitcoin. So the major target I have is 20,000. So far, we've gotten as low as 25,000, but 20,000 brings us back to the high from 2007. So that's my high-end target. The way I get my 12,000 target price is by doing what's called a measured move. And the measured move basically is taking this high, which was the 69,000 high. You basically went straight down to 33,000. So you take that distance here, and then you take the highest point on the bounce before the next leg lower, and you stretch that out. And what you'll notice is that if the same distance from here to here, this is the same distance to here. And this is something that very commonly happens in charts as well. And it's called a measured move. And that gives me my low end target, which is right around 12,000. So I know I'm throwing a lot of kind of, technical stuff at you guys, but it is worth paying attention to. And again, technicals have served me unbelievably well. I was never a winning trader before I got into technicals, and that was the game changer for me.
Maybe let's add on to that a little bit with your process then. Being that technicals is important, right? I always say that it's not really to predict what's going to happen. It's to prepare you and give you better risk to reward trade. So what is it that, maybe if you can walk us through your process a little bit, maybe on the day-to-day, or what time frames, or, get a little bit more in depth there, what takes place? Yeah.
And you're so right. I mean, I think that's important, is like, there's plenty of times where technicals fail, right? So there's no perfect magic sauce where you can never lose on a trade. I lose on trades all the time. But what I found is that by using the knowledge that I have on technicals, I'm able to put probabilities in my favor. So if you can get to 70, 80% win rate, which is 7, 8 times winning out of every 10, the math takes care of itself in terms of your money. It just continues to grow. But again, it does fail just like everything, and you have to be prepared for that. My process in general is just, I look at mainly the daily chart. For me, as a swing trader now, for day trading, you look at the intraday. I usually go the 10-minute and the 60-minute, but for swing trading, which is holding a stock for days to weeks or months, usually less than a year as a swing trade, I'm going to be focusing on the daily chart and looking for major pivots, gap fills, double tops, double bottoms, bottoming tails, like all these kind of terminology things that you hear. They're all things that put the odds slightly in your favor. And what I found is that when you find a level on a chart where you have more than just one of these factors, let's say you have a bottoming tail and the tail happens to coincide at a gap fill, the odds increase, right? So the idea is that one factor or one signal may give you only 50, 60% success rate, not that great. But if you can get 2 or 3, you're pushing yourself towards 80%, where the odds become something where you actually do want to take that trade. And so, for instance, I always say to people, like, think about being the casino, not the gambler, right? When someone knows nothing, they're gambling in the market, and they're usually going to lose, and odds are against them because there's sharks in the water, meaning algorithms by institutions that are trying to sway you. There's emotion from social media. I mean, all these things are trying to get you to do the wrong thing. When you block that out and just go to the charts and find multiple factors, you become the casino house. Not that a gambler won't come in and take you for a trade here and there, but overall, 1,000 trades, 10,000 trades, you're going to win a higher percentage. And that's the bottom line.
Awesome. Now, when you mentioned bottoming tail, so, for example, I'll just maybe the IWM. The IWM has been in this pullback. It's coming down to a previous COVID high. Do you specifically look for like a key level to enter into, or are you more of a zone trader? So if it comes into the zone, you might put your feelers out, and if it dips a little bit deeper into the zone, you'll add into that position a little bit more. And then at what point, and then at what point, maybe percentage wise or dollar wise, however you look at it, will you say, okay, the trade's not working, just dump it?
Yeah. And that's such an important point, is that, so number one is my process. And this is something that's kind of evolved since I started as a trader. When I was a young trader, I always thought I was invincible, right? And I would go into a trade and not even think about the money. I'm just throwing as much as I can, because a young trader, a new trader, thinks that they're going to be right? You haven't been burned by touching the hot stove yet enough times. And now I've gotten to a point where I've been wrong enough in my career, and I've taken big losses in my early career that really decimated my portfolio, to where I say, okay, before I even enter this trade, when I'm just watching a trade, what is the total amount of money that I'm willing to commit to this trade, right? So is it 100,000? Is it 50,000? Whatever it may be, you figure that out ahead of time. And then when it gets to that first level and those factors, what I'm doing is I'm usually choosing a percentage of that to initially put into the trade. So I might say, okay, well, let's put 25% of what I'm willing to 25% of that 100,000, let's say. So I'm putting 25,000 in. And then if it happens to pierce the level and get down a little cheaper, I'm willing to put another 25 in, again, 25, to build that core position on a swing trade basis. The key is, in my old times, I would have gone in right away with 100,000. And then when I'm wrong, I would have said, well, I guess I got to put another 100,000 in. And before you know it, if that trade doesn't work out, it becomes a blow up scenario for your portfolio. So absolutely, you have to kind of think about that. And you just brought up the IWM, and I'll just show you guys this. It's just such a cool thing, right? So just look at the level right here. And I actually did buy this. So I only put 25% of what I wanted to put in, which was about 2% of my portfolio. So in other words, I was willing to go up to 8%. But look at this high pivot over here before the COVID collapse, and then look at the run. And then we went right back there. And what's it done? It's bounced beautifully. Now, on that same kind of thought process, let's talk about, well, where was I going to add to the position? Because I only did 25% of what I was willing. Well, just below that, you have this beautiful gap fill. See this gap right here and this pivot high right here? So this is where I would have added more to the position if I needed to. And again, you have multiple pivots right in this area where you can add to that position if fear and panic drive things. Because I think that's important to mention, is that levels can get pierced. They're not invincible because the markets are ruled by fear and greed. and fear is very pervasive. So it may pierce your level, and you have to be ready for that. And you have to have a game plan for that.
Yeah, absolutely. Let's hop into some of these questions that I got kind of from my community. You may have answered some of them, so we can skip through. But the first one is, what's your checklist before you take a trade? And well, you already mentioned what timeframes you look at. It depends on, whether intraday or if you're swing trading with daily. But do you have a checklist, and what is it?
Absolutely. Absolutely. So the first thing I do when I'm trading is I look at the market cap of the company. So in my early years, I was big on small caps because small caps can move massive percentages. As I've gotten older, I don't like the risk of that. It's too risky for me. So I've moved to larger companies like Apple, Microsoft, stuff like that. I'll play Tesla as well. It's a big company, but it is very, very volatile. I'll play double ETFs and single ETFs. I very rarely will take the risk of a triple ETF anymore, because if you're wrong, you get hammered so quickly. So there are absolutely things that I'm looking at when I'm scanning for trading opportunities. There's also some things like volume, right? If I'm an investor and I have a fair amount of money, I can't be going into a stock that trades 20,000 shares a day and then me buy 10,000 shares, right? Because if I need to get out of that position, well, how much of a hit am I going to take just unloading that? So I like liquidity. I like the ability to get in and out easily without those extra risks of illiquidity in there. So those are things I watch for. And then I really go into the chart. And I say to myself, okay, well, what are my factors here? Is this chart, which is falling sharply, is it coming into a major level here? Does it have other signals? What's there? And I basically go through a checklist of technicals, looking at things like moving averages, Fibonacci retrace, stuff like that, including, levels like gap fills, pivot highs, like I just showed on the IWM. And I try to formulate, all right, do I have enough factors here which makes me feel comfortable? And then, of course, lastly, I say to myself, well, what's my full position going to be? So I think about that before I enter. And then I think about, okay, where will I add? And then what if something crazy happens? What's my worst case exit strategy? And that's really kind of the idea, is you want to have every angle covered before you get into the trade, so that nothing surprises you. Like, you don't want to get punched in the face by a trade and then be sitting there stunned. You need to be able to react.
Absolutely. Okay. Yeah. Nice. You had mentioned moving averages. Is there specific moving averages? I know there's no holy grail moving average, but are there ones that you find to be valuable, or ones that you use consistently?
Yeah. So, I mean, for day trading purposes, like the 20 moving average on the intraday chart and the 50, for the daily charts for swing traders, I think the bigger moving averages are more important. The 20 on the daily can get chopped through quite a bit, so it's not as powerful. I don't use that as a signal, but certainly I'll keep an eye on the 50. A lot of people use the 100. I use the 200 moving average. The bigger time frame ones, because they're taking into account a longer period or a longer trend, they're going to be more powerful for levels where if you hit them, you're going to have a reactionary move off of them. So definitely some of those bigger ones for sure.
Gotcha. Is there a specific indicator? So somebody asked, besides Twitter sentiment, do you have a favorite indicator? I'm assuming that he knows something about you. Have you said that's one of your favorite indicators before?
I have.
Okay.
I have. And it's kind of funny because like when I was posting, when I started to first talk about 20,000 as a target on Bitcoin, when it was like at 65,000, I mean, the amount of negativity and people just calling me like crazy, it'll never go below 60. And then it did. And then, it'll never go below 50. It was just so massive. And so what you learn is that when the masses are that riled up emotionally, and it was all emotional, it wasn't like, well, the technicals say this. There was nothing about the technicals, right? It was all like, no way, where it's going to go to a million. You start to recognize when there's a maximum volume of kind of that using it as a contrarian viewpoint. So Twitter is a great way, social media in general. Not to call out Kramer, but just the other day he called Cathie Wood the kiss of death on a stock, right? And the second I heard that on CNBC, I was like, buy ARKK, right? And what did it do? I mean, it legit that day bottomed out and bounced. Now, again, I don't know if it's going to bounce a significant amount, from here, but the idea as a trader, you start to kind of catch on to these things that when someone in the news media is saying something, they have a lot of followers, it's that pivot point of emotion flipping where there's too much bearish sentiment. And now you're going to start to see that inflection point. So yeah, some really cool stuff. I mean, as you kind of get into this, you start to think and hear things that you normally would have never thought or glossed over, and you start to think about them differently. And it's a very cool thing.
Right. Yeah. All right, so another question is, says, I've been following your crypto calls for a while and they've been generally correct and helpful, which is very impressive and much appreciated. I am bullish on blockchain technology, but I have concerns regarding Tether and the continued proliferation of alt trash coins. In my opinion, the Tether fraud issue needs to be resolved and that trash coins must be reduced to nothing before I consider the crypto markets as a investable asset. Do you have any thoughts on Tether situation or on the thousands of altcoins in existence?
Yeah, so number one, I agree. One of my theses for the collapse on crypto that will take us to maybe as low as 12 on Bitcoin is that it's so eerily similar to the beginning of my trading career with the .coms, where you had .coms that were run out of their parents' basement. They literally made almost nothing. It just had like .com on the name, and therefore it got this crazy like 50 million valuation or some crazy valuation, and it just wasn't healthy, right? And you have meme coin Shib now, and you have Doge, and then there's literally like 19,000 cryptos out there. That's not healthy for the system. It's overpopulation. You need to kind of clear that out. So I 100% agree. I'm in the same camp where I'm not a buyer for a long-term investment in Bitcoin, even though I'm super longer-term bullish. I think it's going to 500,000 eventually. But in the near term, I'm only a swing trader, meaning I'll buy support, sell resistance, but I can't be a long-term holder until I see this washout occur. And I think it'll be very clear. There's going to be a lot of fear, a lot of panic over the crypto area. People will talk about maybe this doesn't survive. Maybe it's not going to work. That's what you want to hear. What we were just talking about. We were talking about how you had this scenario where you have to hear these contrarian viewpoints to actually think there's a bottom. So I think that that's really important, and I think it's worth keeping an eye on. So I'm with this follower, this viewer. Absolutely.
I always tell people, I've been telling people in some of my videos that, do not underestimate how far something can drop, even if it's a great asset. I mean, we've seen the .com bust where Amazon was down like 95% or something like that from peak to trough. And even McDonald's in the 80s dropped significantly like that as well.
Yeah. And I also think it's important to recognize, like, I don't know if it'll go to 12,000. I don't know if it'll go to 20,000. What I'm going to do is I'm going to DCA in, dollar cost average in, right? So when it gets in the low 20s, I'm going to, again, same kind of structure. I'm going to say, okay, I'm willing to put X amount of dollars in Bitcoin. And I'll probably start with like a 1/6 position. So 1/6 of that money, maybe I'll buy just above 20 in case it doesn't pierce 20 and I don't want to be left with nothing. And then every like $4,000 down, I'll just buy another, very robotically, because again, none of us know where this is going to go. All we can do is trust the charts. But again, at the same time, if you're a long-term believer of it going to 500,000 or maybe higher, then, you want to make sure you get some feet in the water at that point.
Absolutely. Well, I got a couple more questions if you got the time here. Cool.
Sure.
So for, I guess, what would be your advice for like the Bogglehead style investors or passive retails who rely on indexing or the 60/40 portfolios, during this potential multi-year bear market?
Yeah. So, indexing, the index investing and stuff like that, it was great when the Fed was backstopping it. It was very rewarding when you have, stocks like Apple, Amazon, Facebook, Google / Alphabet, Tesla. When all these mega cap stocks, and remember, those stocks made up like 50% of the NASDAQ 100 and like 25% of the S&P. So it was great on the way up. But remember, if these things are coming down, it could get pretty messy. And I still think Apple has a lot more downside to go. I still think it's a very expensive stock relative to where the valuation should be for its growth. So it is the prized gem of the markets. But usually in a bear market, that's how you know a bottom is in, when that last gem is kind of tarnished, right? So just be aware that this is a market that's not backstopped by the Fed. So you have to be a little bit more nimble. Or you can just say, hey, listen, I'm not playing ball. There's nothing wrong with sitting on the sidelines. Everyone's so worried about, the being in dollars. But I'll tell you one thing. Number one, the dollar has been super strong this year. So it's gone up more than anything else almost. And number two is that when you're in cash, you're ready for any opportunity. When you're fully invested, you could have the best opportunity coming and you may miss it because you don't have any money to invest. So nothing wrong with having some cash on the sidelines.
Absolutely. Cool. And then I guess before we close it off, there was a kind of just a question on Twitter followers. Is there anybody on Twitter that you would recommend following? Obviously, besides yourself, And potentially also any like services. So you have in the money stocks as a great service. Are there any others that you might look at? For example, like, FinTwit, Community, Flow Algo, Bloomberg, whatever the case may be.
Yeah, I mean, I do trading view, the charting. That's been I actually just joined that about like 6 months ago, and I've been very impressed with their charts. They're so easy to program, they're so easy to read, to zoom in, zoom out. Really, really helpful when you become a technical trader. There's a lot of indicators on there I don't use, but it's very easy to kind of put them in, take them out. In terms of services, I don't have much. I would definitely say, decide what type of trader investor you are. And then you can kind of explore. I mean, whether you want like a Bloomberg, which is news related, or a market watch. I mean, those are relatively cheap. But for the most part, I think people need to just go for education, right? And this is the biggest point, is that when it comes down to learning how to trade, the market's either going to make you pay or you're going to pay to learn, right? And I'll tell you from personal experience, paying the market cost me way more. I mean, basically cost me what to become a doctor would have been, if I could go back and do it over, I would find someone who really knows the technicals and try to learn as much from them. It would probably cost me 10,000 and that would have saved me hundreds of thousands of dollars. So education is number one. You don't want to be the weakest one in the pond or the smallest fish in the pond. You got to learn to grow. And remember, there's algorithms out there from institutions that will be out hunting for people making the wrong decisions.
Absolutely. All right, Gareth. Well, it's been a pleasure having you on. Where can people reach out to you if they want to get a hold of you or follow you on your socials?
Yeah, so best place is Twitter at Gareth Soloway. So just at my first last name, and then if you want to come and check out the services I offer in the verifiedinvestingcrypto.com is the crypto website. Every day I do a daily video with hardcore technical analysis in it, great education in there. And then same thing at inthemoneystocks.com. I have a service called Verified Investing Alerts. Same thing, trading alerts, as well as a daily video. So lots of good quality content out there, and that's the key is, folks. I'm all here to try to teach, because at some point I will hang it up and retire, and I want people to be able to do this on their own once I'm out of here.
Awesome. Well, thank you so much, Gareth. We appreciate it.
Thank you so much for having me.